Hi, I'm Jimmy. In this video, we're looking at Verizon stock, ticker symbol VZ. So this video is part of our Dow 30 analysis, where we're analyzing all 30 companies in the Dow Jones Industrial Average. We are up to Verizon. We're just going to run right down the list and finish all of these, hopefully sooner than later. So what we're going to look at is we're going to look at the basics of Verizon's business, then we're going to look at some of their numbers, and then we're going to try to come up with the fair value of Verizon stock using discounted free cash flow. Ultimately trying to answer the question, do we buy Verizon stock today? Now, before we jump into that, I just want to tell you about a website that we're building. And we already built the discounted cash flow calculator, but basically the website at some point is going to help us do all sorts of investment research, value companies, in addition to other things, using all different valuation methods. We already built the beta version of our discounted cash flow calculator. But the advantage of signing up now before the whole thing is complete is that if you came over, let's say you came over, you signed up for a year, well, we're locking in the price, so the price will never go up on you. You come over, you sign up on an annual basis, you get your price locked in forever, and you could be part of our private investing community as well. Okay, that being said, let's jump over to the basics of Verizon's business. So Verizon has their business broken into two primary segments. We can see that their largest segment is their consumer business. Now, their consumer business consists of two primary categories. They have wireline and wireless. On the wireline business, we're talking things like Verizon Fios, which is their fiber optic network, and their DSL network, their more traditional internet provider network. Plus, they have their wireless business. So that is their primary revenue generator, their wireless service business. And one important news event that has happened recently is Verizon acquired a company called TracFone. And this is a company that was out of Mexico. They bought the business. They paid about $6.5 billion for it. And this is one of the largest prepaid cell phone providers out there. So this improves Verizon exposure to that business. Then their business segment, that represents about a quarter of their revenue. By the way, these revenue numbers are going off of the past 12 months. Well, their business segment is broken out in a very similar fashion. They have wireless and wireline. Although when we look at their bigger breakdown, their business segment, they really break out by the size of the customer. And they have wireless, wireline, and a few other business services in there. And then their consumer segment, the blue segments, well, they break it out by services, which is something like Verizon Wireless, and then their equipment, which is obviously a much smaller percentage of total revenue. Okay, now let's jump over to some of their numbers. So this is a chart of Verizon's revenue going back to 2006. And we can see that we also have 2 years of analyst estimates here. So everything before that are actual numbers. The last 2 years are what analysts are currently estimating Verizon will get for revenue. And we can see that growth over this entire time period has been there, although it hasn't been huge. Just to illustrate that, in the past 5 years, their average growth rate for revenue was a bit over 1%. It was like 1.2% on average on an annual basis. So revenue hasn't been all that great, but it's been somewhat steady. The bigger concern for a company like Verizon, or really any company in the industry, is frankly their debt. The entire industry generally has a ton of debt. This is a chart of Verizon's debt. Again, this one goes all the way back to the year 2000. But in my mind, the most important years here is the jump from 2020 to 2021. We can see that that was a massive jump in debt. But to explain that jump, really we should add another line item to this chart. The orange bars are a representation of the acquisition of fixed and intangible assets that Verizon has made over the past 20 or so years. But once again, let's focus on just the 2 years. We can see how big of a jump we saw from 2020 to 2021 for the acquisition of fixed and intangible assets. Now, if we're curious what that is, well, the primary expense that came out of that big jump came from the acquisition of wireless licenses for different frequencies. So the government ultimately issues licenses and the different companies bid on those licenses. Well, Verizon ended up bidding the most in what was called Auction 107. We bid for the different frequencies. The most important frequencies right now are the frequencies that are going to be used in 5G. Verizon bid about $45 to $46 billion in the most recent auction 107. So the 46 or so billion dollars that they spent on the licenses is really what forced them to increase their debt as much as they did. But yes, this is a negative sign from a debt standpoint, but also this is necessary for them to grow their business. In fact, if we were to jump over and we were to look at how much money the different companies spent, well, we could see that Verizon clearly outspent everybody. They doubled what AT&T spent, and they were a mile ahead of where T-Mobile was. So since these expenses are being used to acquire the licenses to really set up the 5G network, or to continue to set up the 5G network, owning more of these is a good thing from a future cash flow of the business, a future growth of the business. So the fact that they're taking on more debt, yes, is concerning, but there is a logic to it. It's not like they're doing it to continue the status quo. That growth rate we saw before, they're trying to increase that growth rate by coming out number one out of the whole 5G sort of revolution that the industry is trying to make. The bigger concern, I think, with debt is not necessarily the amount of debt, but many people have pointed out that with rising interest rates, companies with large amounts of debt are going to face a bigger problem. And that is true, but not all debt is the same. We can't look at their $175 or so billion and say, well, that debt is going to be a problem right now because they're increasing because interest rates are going up. Not all of that debt, most of that debt is fixed. Not all of it is going to renew anytime soon. In fact, we put together a chart based on the research that we've done. We put together a chart of the maturity dates for a lot of the debt that they have. This represents, I believe, about 130 or so billion dollars of their 175 billion. The newer numbers are a bit tougher to come across, but I'm assuming they go out a decent amount of time. And we can see that next year, about $1 billion is maturing for Verizon. Most companies will, when that debt comes due, they will issue a new $1 billion bond. They will pay off the old bond. And in theory, they could have a higher interest rate. The following year, only about $4 billion is due. Now, the question is, when are interest rates going to stop rising? Are they going to fall again? Are they going to go even higher after that? We could see that this goes way out. The most recent years are going up to past 2050. So it is very difficult to say that, oh, because they have a ton of debt, all their expenses are increasing. Most of these are going to be fixed rates. So it's not quite, I just wanted to bring this up because I didn't want anybody to think that, well, 170 billion in debt, interest rates are going up, therefore they are in trouble. If interest rates turn and head lower in 2 years because the Fed overshoots and they raise interest rates too much, they probably will. If that happens, well, I think that could be, I think that's a misrepresentation of the reality. That being said, this is important to coming up with a fair value for the stock. So let's jump over to the discounted cash flow calculator that I mentioned before. So this is a discounted cash flow calculator that I mentioned before. Again, link in the description below if you want to sign up. But basically what we do is we take analyst estimates for free cash flow going out the next few years, and we discount that back to today. I'm using a required rate of return of about 9%. Well, at 9%, we get a fair value of about $30 per share. That is after we account for their debt. If we hadn't accounted for their debt, the fair value would be about $72 per share. Now, in a case like this, I actually think it makes a lot of sense to, some people have debated whether or not we should account for debt. I think it makes sense to include debt, but if we want to be less conservative, maybe we take a middle ground. For me, before I would consider buying a stock like this, a company like Verizon, I'd like to see it drop below our calculation of fair value. Right now, I have it at $30 per share. I'd like to see that come down a bit. I'd like to see the stock come down a bit before we jump in and buy it. Now, if you'd like to sign up to get access to the website, I will leave a link right here. I'll leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.